We are recording today so we can put it up on our YouTube.
Have much prepared. I mean, Homespire Mortgage, we do a lot of government loans. So that's like your USDA, FHA, and VA loans. With this COVID, everything seems to be taking a lot longer than it used to. I mean, anybody having appraisal issues? Ian, Matt? And Matt, can you hear me, buddy?
Yes, I can. Yeah, sorry, there's a little bit of a lag. I haven't had any, in terms of responsiveness from appraisers, in terms of turn times, it's definitely been longer than, let's just say, under normal circumstances or prior to the interest rate environment that we're currently in, as well as, the tight market with very limited inventory out there. So the appraisal turn times have been slower, but values have been coming in, sufficient for the request by and large.
Gotcha. Yes, same here, guys. We're taking, it's taking us 2 to 3 weeks to get our appraisals in. We do have an appraisal desk, which is really nice. So we're not using a AMC. But yeah, so we're pretty much telling our clients it's going to be 2 to 3 weeks before the appraisals come in, and just get everybody prepared for that. Ian, how about you? What are you seeing like as far as your appraisals go?
So it's interesting. We have an AMC that we use, and they have a panel of approved appraisers. And we have 2 or 3 of them that will not go inside of a house. Have you ran into that, Brian, at all? I
have, yes. I have.
Okay. So, that kind of poses a problem. Obviously, any secondary market loan and even our in-house loans, and I assume Matt feels the same way. We want to look inside the house. We have to for a purchase transaction, especially. And if an appraiser can't go inside the house or will not go inside the house, we can't force them. And there is, of course, a shortage of appraisers, I think. So all that's led to is us using the 2 or 3 that will go in houses, and it's created a slightly larger lag, like 2-3 weeks for sure.
I mean, there is sometimes, like, if we're doing a conventional loan and we run it through DU or LP, which is Fannie Mae and Freddie Mac, and a lot of times we don't need an appraisal for conventional loan. However, the borrower has to sign off on it and be okay with it. And it's really just for really strong borrowers. Are you guys doing those as well? Ian?
I don't think our mortgage department's going to do that. We're going to want to take a look at our collateral. Most of our loans are portfolio and not secondary market. So, we have a vested interest making sure the property is suitable for the borrower after they move into it. So, I've done drive-by appraisals on the commercial side. So I can do that. I can get away with that, but not for the consumers. We need to be in the house.
Gotcha. Another thing we see with this COVID and everything going on, the interest rates are crazy low. I mean, this might be the last boom we see as far as refinance boom in a long, long time. So I can tell you, as Homespire Mortgage, and I'm sure same with Matt and Ian, we are remaining 100% purchase centric, because, the refis are nice, but we tell our refi borrowers, look, it's going to be 60 days plus, because we have to make sure our closings are happening on time. I mean, I've been on that side of the table where you're sitting there waiting on a package, and there's 3 other closings that have to happen, but that can't happen until your loan closes. And let me tell you, it's a bit stressful.
Yes.
We've been there, and it's not fun.
Hey, Brian,
yeah.
How long do you recommend that they give on a purchase contract?
Okay, so I went ahead and looked at our numbers, and pretty much we're no longer than like 45 days out on purchase. So about 45 days is a pretty good number. One thing to remember is, like, VA loans, we don't have control over the appraisers in that circumstance. It's like on a round robin. So with VA loans, what happens is once they get assigned, the VA appraiser has up to 14 days business days to turn that appraisal in. So VA loans are definitely at least 45 days. How about you guys? What are you guys seeing?
Matt, I don't see it much on the mortgage anymore. Matt, what do you got?
In relation to turn times for files, we're doing 60-day rate locks on everything, even on purchases, just in case. And in relation to the government loans and stuff, if it's USDA or VA, we'd like to have as much time on a purchase as possible, because they constantly change the overlays for underwriting on those, and we do, of course, we originate and sell those loans. It's not something that we hold, so it generally just takes a little bit longer to get those in and out. In relation to your comments on the appraisals, in terms of waivers, on anything that we do that is secondary market conventional, we can, of course, cross our fingers and hope for an appraisal waiver. And we do use those as much as we can, not only on purchases, but most specifically on refis. If, the desktop origination portal says, they're okay with the value that's entered, we certainly would not request a physical appraisal be done if the PIW is awarded. I most often see those on deals where the property is in a development where you could easily pull up comps. Those are most often not rural properties, and especially up into Morgan or Hampshire County. The appraisal waivers are coming in a lot better in Jefferson, and then the areas of Maryland that we service as well as southern and central Pennsylvania.
I do want to say real fast about USDA loans. As of February 16th, USDA pretty much integrated to a single national team. So pretty much we have to underwrite the file, and all my underwriting is done in-house, as is my processing. And pretty much, we went from having like a 2-day turnaround time whenever it was, local, to it can take, up to 7 days for these, for them to give us a commitment letter for USDA loans. So that's has caused some headaches.
Hey, Brian, what are some last minute things? And again, I'm on the commercial side, so I only hear secondhand, but Dave Pill mentioned, last minute VOEs that are tanking deals and things like that.
Okay. So we are a correspondent lender. Being a correspondent lender, we do lend with our own money, but then we sell the loans. So a lot of the investors due to COVID are pretty much requiring these last minute VOEs and last minute calls. Now that we have actually got a little easier like in the last couple of weeks, but for a while there, it was we were doing like 24-hour calls before closing. Trust me, it's no fun.
Yeah.
It's not.
Yeah. In relation to what we're seeing in terms of conventional refinances or purchases, you read the DO findings, it says a pay stub, a W-2, so on and so forth. You gather these documents, but what our secondary investors that we sell these conventional loans to are requiring now is a pay stub that is dated no earlier than 2 weeks prior to closing. So if we collect those items from the customer up front and it takes 45 days for the sake of discussion to close a loan, we're going to need an updated pay stub from them showing, basically more current, showing that they are still in fact employed if we're not doing a written VOE. They also do that on the mortgage statements. So if I collect a mortgage statement from you up front and it was dated, for the sake of discussion, having you due for September 1st, and then we close you in the middle of October, I need to see the 10-1 statement showing that you made your payment for September.
Wow, Matt. So if we can pivot over to your side, and thank you. Thanks, Brian, for your section. Maybe talk about in-house and how it could be maybe a little, some of the advantages and disadvantages for in-house lending, and also what the realtors can do to help facilitate the transaction. What do you think about that?
Yeah, so excellent point and question. We're obviously in a strange environment right now because the 30-year fixed and 15-year fixed secondary market funds are cheaper than ARM loans. And that is a very difficult thing to kind of brand to the customers, because this is something that has not happened in years previous from what I'm to understand. But on our portfolio products, basically what is getting funneled that direction now are the high balance loans, construction loans, of course, things that are non-conforming like a lot loan, or if you've got a unique property with 2 dwellings on it, or you've got a unique situation with how somebody is paid, from whatever their employing entity is that a bank could work with, but the Fannie Mae, Freddie Mac underwriting guidelines, can't give their blessing to.
Mm-hmm. What can realtors do maybe to, make us get to the table on time? Anything they can do to prepare the client or?
In terms of the portfolio stuff, there haven't been any major overlay changes or bank policy changes for CNB. So based on COVID-19, of course, we're going to dig into the files harder for those that are self-employed and maybe have processed PPP loans. I know that on our conventional loans that we originate and sell, anybody that is self-employed has to provide a COVID-19 letter stating the exact description of their type of income, how they are paid, what type of industry they service, and that they have not been affected by COVID-19. So these are all things that, get requested from the lender that gets kind of translated sometimes to the realtors in relation to, good Lord, they're asking for a lot of paperwork on this loan program, which it is. And there's really no way to get around that. But the goal with all of this is for, take the 6 weeks of, inconvenience on gathering the paperwork for the long-term gain of the super low interest rates, that everybody's locking into.
Mm-hmm. Are there any, I've heard that there's been some changes in overlays that you mentioned. I've heard, it's a lot harder to get qualified now. Is that government? Is that in-house? What's different now? It doesn't seem like it's a problem when there's so many buyers that are qualified and the market's on fire. But what are some of those changes making it more difficult to get a loan now, Matt?
What I've seen primarily this year is very good paper in terms of qualified customers. It seems like everybody that is most qualified has been watching the market and has been trying to finally make the large purchase or finally restructure their refi, whether that's by means of cash out or, to pay off a home equity because they've got market appreciation now or something like that. But I think it's really put the squeeze on the lower credit borrowers in terms of folks that are at the 660 or lower. For our USDA products, our investors are requiring 660, whereas prior to pandemic it was 640. I know there are other lenders out there, such as Homespire, that could previously work with lower scores for USDA via a manual underwrite or something like that. And the same thing for the VA customers. But our VA scores, I believe, are at 660 now, based on the investors that purchased them. The same thing with USDA.
Yeah, good point, Matt. Yes. We're seeing stuff, we're still doing stuff down to 620. However, we do our best to try to get their scores up prior to closing so we can get, better rate or so we can get it through. But yes, it made a big difference when COVID hit.
Mm-hmm. Brian or Matt or both of you, how do you guys treat if you see a forbearance on their credit report? And do you see a forbearance on their credit report? Should agents tell their customers, hey man, get that back in payment before you apply to buy a house?
So that's a great question. I actually had that pop up on a refinance today. And I have the conversation with the customer if they've got a pending sale and they're purchasing a new house, about the status of their current mortgage or if they're doing a refi in the same fashion. What has happened with a couple of my files, a couple of customers, is they called in earlier this year to their lender and inquired about forbearance and did not take it, but that the lender still put it on their credit report. Oh. So in this instance, what we would have to do is like a verification of mortgage to the existing lender that shows that they've made 3 payments, the last 3 months payments, because you have to be three consecutive payments being out of forbearance or a loan deferral before we could do a new mortgage application for you.
Wow. Important.
So, yeah.
Okay, I was going to use that point to pivot to my piece, if that's okay. And I don't mean to be the doom and gloomer, but right now, and this is an article from yesterday, the shares of mortgages that are in forbearance, it dropped to 6.93% as of September 13th, according to data from the Mortgage Bankers Association. The trade group estimates roughly 3.5 million homeowners are in forbearance plans that allow them to skip or reduce monthly loan payments. So, to pivot that to the commercial piece, which I was going to cover, there's a lot of unknowns, and we can't underwrite and we can't look at a credit with this much uncertainty. I mean, certainly we can and we will, but what we've had to do, and I can circle back around to the foreclosure thing or piece that might be coming as a result of all those folks that are in deferment, but was to talk a little about credit enhancements. So I'm Ian, I do the commercial lending here locally at City National, which is a lot of, I'm doing a lot of investors that are purchasing real estate and, townhomes, single families, that kind of stuff. And, more complicated things as well. And when I say credit enhancement, what that means is we might require that somebody set up a payment reserve. If you're going to buy a new apartment complex and it might need a little work or whatever the situation merits, we might require that you set aside a few months of payments and put those in a reserve if times, things do turn next year. Let's see, we allow shorter amortizations. If we're going to do traditionally maybe a 20-year loan, if we're a little dubious, we may have to shorten it to a 15-year amortization. Certainly for particular industries have been affected differently by the pandemic. Of course, lodging has been, just decimated. I don't know the current figures, but, occupancy rates that used to be, 70, 80%, I think national average was almost 70%. We're now in the 30s, and every market is a little different. Of course, business travel, is nil. No one at City National is allowed to travel for business unless it's to meet a customer. So we're not, doing the tour of our footprint. And to speak more about hotels and restaurants, particularly the service businesses that have been impacted negatively, how do I approve a loan for a new restaurant? If someone wants to open a new restaurant, it's going to be extremely challenging to make the bank comfortable with a loan like that. We're worried about folks and their decreased capacity to service their debt. And that all comes from cash flow, which isn't flowing if you don't have revenue, and you don't have revenue if you're not allowed to be open, et cetera, et cetera. So that's a whole nother thing that I don't want to get into. But as for lodging and hotels and motels, there's clearly a moratorium on them, so we can't do a loan to buy a hotel right now. In fact, we have a whole bunch of our portfolio on forbearance as well. I mentioned, nationally that number of almost 7% for mortgages. I don't know what it is. Every bank, I'm sure, is different. At City National, most all of our hotels are on some form of forbearance, and we won't be making new hotel loans anytime soon. And the question becomes, what's going to happen in the future? We can't just say, well, you don't have to pay interest, or you don't have to pay principal and interest, or we'll just pay us interest for a few months. It'll be okay. That's going to be okay for a while, but eventually those become troubled assets and it becomes a regulatory issue. And I don't know how what it's going to happen. I've read articles how hotels will be converted to condominiums or, retirement homes, that kind of thing. And they're going to need to be repurposed, just like they're repurposing malls into doctors' offices and things like that. What else did I want to discuss quickly? Some of the benefits. How about the good news of using a commercial loan if you have an investor looking to purchase real estate? And this is where, my heart goes out to my residential lenders, which I did for 7 years, so I know your pain. But we can approve a loan locally. If the borrower meets our metrics, the cash flow, we like the loan, we're going to make the loan, it's approved. There's no last minute VOEs. There's no extra regulatory burdens, which need to be in place and are in place for consumers, that commercial has a little bit more leeway. All I really need for, say a simple townhome purchase would be an appraisal and a title order. So if borrower, it all makes sense, the value is there to meet our loan to value requirements, we can make the loan, and I can usually do them very quickly. And again, it's just a different animal from the mortgage side. And the trouble now with investors is they don't want to pay $175,000 for a townhome that they can rent for $1,300. They want it much less. They want to get in much lower to have a stronger cap rate. So it'll just be interesting. I've done a few of them, and I've had bidding wars, which I'm sure everyone has. And I did have an appraisal or two that didn't quite come in where it needed to be. And the investor was willing to pay more anyway, because he had to, he had to get in while the getting was good, I suppose. And we got those loans done. So I'm telling you, it could be, 3-4 weeks still for a good investor for a simple, purchase. Now, a commercial appraisal is a lot different. Those would be for multi-unit properties or, actual commercial real estate and not residential real estate. So that's a little bit different. But for the residential stuff, it should be pretty easy for the commercial side of things. What's the future going to hold? I'll circle back to this, not to be too doom and gloom, but right now, and you guys, know better than I do how risk the market is right now. The question is going to be next year, if there is an issue with an increase in foreclosures, which I'm sure there's going to be, will the market absorb those, or will there become a glut of homes that might reduce home values? So I don't know the answer to that. Nobody does. The thought might be that there will be enough of a demand to absorb some of those homes if they come on the market as foreclosures. So that's the big uncertainty. And right now things are good. So we're going to make hay while the sun is shining. Right, everybody?
Yes, indeed.
That's what I got, guys.
Awesome. Very good, Ian. Thank you.
Questions?
Guys, I think we'll put it out there to attendees. If you want to hold your hand up and get recognized with a question, I'll certainly be happy to do that. One of the things that I discussed this morning in my meeting with agents was I had seen, because I tend to see the altas as they float through the office, I'd seen a rush appraisal cost of $1,200.
Hey, Margie.
Yeah.
Well, actually, I called our appraisal desk this morning and I asked them about, the fees and everything and rush fees and this, that, and the other. And they told me that, so we charge $500 to $550 for an appraisal.
Mm-hmm.
They said most of the rush fees cost like an extra $100, but in some cases they've seen it as much as $250.
Okay.
Well,
I was just curious. It was a number that jumped out to me off of the Alta, and I was like, that's a lot of money. Okay. So normally 100 to 250.
Yeah, 100 to 250 is the normal, is what Homespire does. I'm not sure about the other companies.
Sure. Matt, can you comment?
The only thing that I've seen recently is if we request a certain deadline for an appraisal, the appraiser will generally either accept or decline it. I have not seen any, let's just say, acceleration fees or a rush fee that's been passed on to any of our customers from an appraiser.
Okay. There's a question from Tina in the chat. Ian touched on future foreclosures, but didn't circle back.
Sure. Well, there is certainly, I think we know, a moratorium on, I guess, government foreclosures now. And I don't know the particulars because there still are some happening. I believe if it's an in-house loan, like what Matt or City do, where, obviously we're granting forbearances. We don't want to foreclose on people, but we don't have that same moratorium that the Fannie, Freddie, USDA, all those loans have. To give you another scary stat, we talked about all mortgages, but the FHA mortgages and VA mortgages have historically been the most risky loans. And the data I have here, loans guaranteed by Ginnie Mae, which are FHA VA loans, their forbearances increased slightly over the past week, rising from 9.15 to 9.15% of those. So that results in a lot of loans. And we all know, what happened last time with subprime lending. And I hate to label those loans as such, but there's certainly some subprime borrowers that wound up in FHA and VA loans. I think we all know that. And those might be the first ones to go. The difference is that people should have equity this time around, hopefully, unless they did a 105% USDA loan. Hopefully they have some equity that instead of foreclosure, they'll be able to list the house and sell it. And just make it more inventory for other folks to swallow up. But yeah, the big question is what happens when the government allows banks to continue foreclosing? We can't just, there's investors that own bonds that are tied to all of those mortgages. And I think the way the law works is they still have to pass the interest on to the investors, which is going to create liquidity problems for any of the servicers. And there was that big issue in the beginning of the year. I don't remember exactly what happened, but there was a big crunch, and a lot of folks that were hedging their mortgages took a big hit. So anyway, we'll just have to see what happens and hope that because prices won't be as affected, people will be able to sell and avoid foreclosure. And that if there are homes that do come on the market, that they'll be absorbed by investors and or individuals seeking to move into certain markets like our market. Now, if we were in LA, this would be a completely different panel and discussion.
Gary, you had a question?
Yep. Hey, Brian, you had touched a little bit about on the extra fees for doing rush appraisals.
Mm-hmm.
And I'm just curious, what does that really buy somebody? What does a rush appraisal mean in today's market? If I'm going to pay an extra $100, $150, how much time is that really buying me?
I mean, it could buy, and we could get something back within, 2 weeks or, a week and a half. And look, guys, we usually don't do rush appraisals unless, a realtor comes to us, or someone's with a bank, a different bank before, and they say, look, Brian, we need to get this closed in 30 days. So in those cases, yes, we do rush appraisals.
Yeah.
But that's how it normally happens.
Yeah. So, I mean, I'm just curious, is it buying me 2 days, 5 days? What's it really buying me? And how does and I know you're not an appraiser, but I'd be curious to see how appraisers approach that, because if they accept a rush appraisal and get paid more on that, does that mean that they're pushing somebody else's appraisal back?
I mean, it's up to the appraisers, and those rush fees, the branch covers them. My branches cover those fees. It's not passed on to the borrowers.
Yeah. And you had touched earlier on the deal with getting appraisals waived as well. Is that strictly on this automated system that you feed this information into, or does it have to do with how much money the borrower can put down and what their credit score is? Is that all part of it?
It's the full picture.
Okay.
It's the full picture. Yes.
All right. Okay. So if your automated system says we can waive the appraisal, you can waive it, and that's the only way it can be waived?
Yes.
Okay.
And that's only on conventional loans. That's not on, VA, FHA, or USDA.
Yeah. Okay. All right. Thanks.
Yep, you got it.
Other questions? Wow, you guys are so good. There are no questions. That's pretty incredible.
I got a question, guys. What do y'all see in the future as far as the market goes? Because, Kath and I, we lived through this before when the market was doing great. We're making money. We're going out to eat. And then overnight we were eating mac and cheese and ramen noodles. I mean, we've been through this before, so what's your thoughts?
Steve DeBruler, I'm going to put you on the hot seat.
Steve.
I was going to wait for all your intelligence. I'm waiting for you to tell the world what is going to happen. I need the crystal ball. So,
Ian?
I'll stand back for a minute and let everybody have an opinion. And if you have questions, I'll answer. How about that?
All right. The only thing I can address is the statistics, because I tend to look at the numbers. And what I will tell you from June 2004 to about December 31, 2005, maybe even March 2006, the median sales price for residential property in Berkeley County went from $150,000 to $226,000. And then when everybody hit the wall, July 1 of 2006, and people decided they couldn't pay the payment, then realistically, we started getting lots of foreclosure activity. Now, the one thing that I will say about that foreclosure activity is those were mortgages that were probably, somebody else, Steve, you were around, the interest rate was probably about 7%.
That's about right. Yeah.
About 7%. Probably the thing about today's market that scares me less, and those of you who have worked with me know that I'll tell you up front if I'm feeling a little fearful, and I've been a little fearful, is that the current rate is 3%. Now, part of the problem is what we're seeing. I mean, the absorption rate in the $400,000 price range in Berkeley County last month was incredible. It was like 50% or 60%. I'm going from memory. So the reality is, I'm kind of thinking if we hit a wall, it's going to be a wall in those upper price ranges, because the mortgagors that are paying in the 150 price range can't go rent anywhere for what they're spending. They can't move to a rental for what there's, even up to about almost 200. So I got to believe it's those folks that have bought into that upper price range because at 2.5% and 3% it's affordable. I got to believe it's those folks who would be the most affected.
No, that's a good point, Margie. And the hits we took that were the hardest in the last go round were the high end homes.
Oh, buddy.
Those are the ones that, we took the biggest licks on. Mm-hmm.
Yeah. And some of those were minus 40%.
Yeah.
Yeah. Some of those were minus 40%. I mean, gosh knows, I don't want to go there again.
Mm-hmm.
Steve, how about you?
Do. Yeah, none of us do. So I'll kind of touch on subjects you're not supposed to talk about for a minute, but I do think that it does depend a little bit on the election and what kind of regulatory stuff comes our way. That could make a big difference in what we see. I do agree with him about the absorption. I think the absorption will be there. The demand is high enough. Even the people that are in the lower quartile that are basically, renting or buying the first-time home buyer homes that are probably most affected by COVID and this stuff, seem to be making through even with the subsidy money, right? So that will run out. The forbearances will come up. The lenders will most likely not give there was some kind of hesitation there of how they were going to make them pay that back as all in full or work it out at the end of the loan or things like that. It's probably highly unlikely that they'll make them pay that back in full on most situations, which I think gives us the time. But really my scary part, I hate to say it, is really the political part of this, right? You add regulatory problems to us, it changes the game, and we can't really jolt the market much better from an interest rate standard, which is typically what they will do to do that. You're kind of at the bottom of the barrel already, so it will have to take its course. But remember, this is not a housing market crash. This is a general population situation for COVID. It's not a housing market problem.
It's employment. It's an employment problem.
Yeah. So it's just not gonna look and feel anything like that. And it will probably be much shorter if you're gonna have foreclosures is gonna happen just because they've got to get this stuff cleaned up.
Yeah.
But we should be able to absorb it pretty easily, I think. And, everybody talks about the exit from the, into the tertiary markets. We obviously, make that as our bread and butter. So, I think that'll probably still ring true for us, right? They can't afford their rental in, wherever, Frederick, Leesburg, Washington, D.C., pick a place. We tend to be the logical move. So that's my 2 cents for what it's worth.
Very cool.
You and I will meet up here again in about 5 years and we'll be smart then.
Mm-hmm.
I would love to know what I know now. Back before all this stuff started, when I got in business, I might have picked it like not getting real estate or something crazy, right?
Yeah, there you go.
They said it'd be easy. Don't worry, right? They lied. They were wrong.
They were wrong.
So.
Any other questions? Guys, I think you've given great information today. And I think that all of you were very good at drawing the differences in the different products that you have. Obviously, Brian has a few tools in the toolbox that maybe Matt and Ian don't have. Each of you have products that all of us can use. There's no doubt about that. One last sign off. I'm going to start with Matthew. I'm going to put you on the hot seat. One last sign off for you. What have you learned during COVID?
That's an excellent question. I don't have an hour and a half to explain. But I would say most specifically, if you think that there's a question to be asked, do not wait. Ask it up front.
Wait, that's important. That's a good one. Okay. Brian, you're on the hot seat.
Well, guys, what I've learned pretty much is we just all have to work together.
Oh boy, that's a good one
We
too.
all have to be cool, calm, and collected, be nice to each other, like that. And just, work together to get these deals done because, there's so many different steps that it takes. You got the attorneys, you got the appraisers, you got the processors, you got the underwriters, you got the closers, you got the investors. I mean, it's just for something to get to the closing table, it's just everybody has to be on the same page. So that's why
And Brian, be pulling the same way.
Yes.
And be pulling the same way. Because sometimes you have people who aren't pulling the same way. It's like, okay, wait a minute here. We're not trying to go back.
Also say, when you're with your clients, just say, look, when the bank needs something, just, make sure you get it to them in a timely manner because, sometimes when closings do get pushed, a lot of times it's because we can't get the proper documents from the client.
Mm-hmm.
Yeah.
And it happens, trust me.
Yeah.
But that's all. That's my 2 cents. Thank you.
All right, Ian, you're up.
I think I've just learned most of the importance of technology, and fortunately for Citi and for CNB, that recently implemented online applications so that customers can handle everything remotely. That was a piece that we didn't have until recently, so it's good timing that we had it. And let's see, so I've learned the importance of technology and that we can work from home. I'm not really at the New York Stock Exchange today, people. So I'm working in my basement. So anyway, that's capable. That was something we dealt with during the PPP thing where I was working till 4 a.m. from home, getting those loans out to business owners. So I guess I've also learned, that being in our community is a tremendous benefit. If we were in a big metropolitan area where no one knew, no one liked each other, the trouble has been the stress levels and, being able to work well with one another and, just having our little community that works well, having the attorneys and the lenders and the realtors that all are able to get along and kind of work together in this crazy environment is a huge benefit. So it just makes me happy that I'm here in the Eastern Panhandle and not, fighting for deals in New York City or something like that.
All of those are great points. I'm going to make a point that Ray Joseph made at the EPBR annual meeting this last week, and we'll end with it. And that is that I think each of us needs not to forget that we are a people business. And, I love seeing all your faces on here. That's a great, great thing. But the reality is that we need to not forget that seeing the people we do business with is really still the best way. And even if you don't see them every time you do business, if you just see them some of the time you do business, I think that it helps the process as everyone continues to move forward. I think in the environment we're in, it's real easy to get pretty insular and say, well, I'm just going to sell $4 million worth of real estate right here from my front porch. That'd be okay. And that's just not how it's going to work. I mean, we have to figure out a way to make it work, technically in a safe, socially distant way, but there's just still nothing that's gonna come before communication in a big way. Last call for questions. Guys, thanks for signing on today. Our next panel is October 6th, and it is the West Virginia Association of Realtors and the West Virginia Real Estate Commission. So hope you can join us. Thanks.
Thanks for having us.
Appreciate
Thanks,
it.
Tammy. You can sign us off.